Quantitative Easing and Proposals for Reform of Monetary Policy Operations by Scott Fullwiler and L. Randall Wray. Section 5. Democratic Accountability and Transparency of the Fed. There is an additional reason to reject undue reliance on monetary policy to the exclusion of fiscal policy. Those in charge of monetary policy are not subject to the same degree of democratic accountability. Further, while the Fed's actions have become more transparent since 1994, when Representative Gonzalez caught Chairman Greenspan in a subterfuge leading to substantial reduction of its secrecy to comply with congressional demands, most of its deliberation remains behind closed doors. At best, it informs Congress of its decisions after the fact. We still do not know exactly what Timothy Geithner did as president of the New York Fed. He has never revealed the full extent of the promises made to private financial institutions, and we do not have a full accounting of all the purchases and deals made. Fed officials are not elected, and by design are not subject to the will of the voters. While the Fed is a creature of Congress, current law does not provide substantive control. In this section, we will explore the issues raised, in particular by relying so heavily on the Fed rather than on the fiscal authorities to deal with the financial economic crisis. Since 2007, the Federal Reserve Bank has mounted an unprecedented effort to stabilize the financial system and the national economy. Faced with the worst crisis since the Great Depression, the Fed found that traditional monetary policy, lowering interest rates, and standing by as lender of last resort to the regulated banking system, was impotent in the face of collapsing asset prices and frozen financial markets. The Fed created an alphabet soup of new facilities to provide liquidity to markets. It worked behind the scenes to bail out troubled institutions. It provided guarantees for private liabilities. It extended loans to foreign institutions, including central banks. The Fed's on-balance sheet liabilities grew to $2 trillion, while its off-balance sheet contingent promises amounted to many trillions more. Congress and the public at large have become increasingly concerned not only about the size of these commitments, but also about the shroud of secrecy surrounding actions by the Fed. For the most part, the Fed has refused requests for greater transparency. Ironically, when the crisis first hit, Treasury Secretary Paulson submitted to Congress a vague request for rescue funds that was rejected precisely because it lacked details and a mechanism to give Congress oversight on the spending. Eventually, a detailed stimulus package that totaled nearly $800 billion was approved. Yet, the Fed has spent, lent, or promised untold trillions of dollars, far more dollars than Congress provided to the Treasury. Most of this has been negotiated behind closed doors, often at the New York Fed. The Fed's defense is that such secrecy is needed to prevent a run on troubled institutions, which would only increase the government's costs of resolution. There is, of course, a legitimate reason to fear sparking a panic. Yet, when relative calm returned to financial markets, the Fed still resisted requests to explain its actions, even ex post. This finally led Congress to call for an audit of the Fed in a nearly unanimous vote. Some in Congress are now questioning the legitimacy of the Fed's independence. In particular, given the importance of the New York Fed, some are worried that it is too close to the Wall Street banks it is supposed to oversee, and that it has in many cases been forced to rescue. The president of the New York Fed met frequently with top management of Wall Street institutions throughout the crisis and reportedly pushed deals that favored one institution over another. However, like the other presidents of district banks, the president of the New York Fed is selected by the regulated banks. This led critics to call for a change to allow appointment by the President of the nation. Critics note that while the Fed has become much more open since the early 1990s, the crisis has highlighted how little oversight the congressional and executive branches have over the Fed, and how little transparency there is even today. There is an inherent conflict between the need for transparency and oversight when public spending is involved, and the need for independence and secrecy in formulating monetary policy and in supervising regulated financial institutions. A democratic government cannot formulate its budget in secrecy, except when it comes to national defense. Budgetary policy must be openly debated and all spending must be subject to open audits. That is exactly what was done in the case of the fiscal stimulus package. However, it is argued that monetary policy cannot be formulated in the open. A long and drawn-out open debate by the Federal Open Market Committee about when and how and by how much interest rates ought to be raised would generate chaos in financial markets. Similarly, an open discussion by regulators about which financial institutions might be insolvent would guarantee a run out of their liabilities and force a government takeover. Even if these arguments are overstated, and even if a bit more transparency could be allowed in such deliberations by the Fed, it is clear that the normal operations of a central bank will involve more deliberation behind closed doors than is expected of the budgetary process for government spending. Further, even if the governance of the Fed were to be substantially reformed to allow for presidential appointments of all top officials, this would not reduce the need for closed deliberations. The question is whether the Fed should be able to commit the public purse in times of national crisis. Was it appropriate for the Fed to commit Uncle Sam to trillions of dollars of funds to bail out U.S. financial institutions, as well as foreign institutions and governments, through repo operations with foreign central banks that lent dollars to them, exposing the Fed to default risk? When Chairman Bernanke was grilled in Congress about whether it was taxpayer money that he had committed, he responded, "No, it is simply entries on balance sheets." While there is an element of truth in his response, it is also highly misleading. There is no difference between a Treasury guarantee of a private liability and a Fed guarantee. If the Fed buys an asset, say a mortgage-backed security, by crediting a balance sheet, this is no different from a Treasury purchase of an asset by crediting a balance sheet. The impact on Uncle Sam's balance sheet is the same in either case. It is the creation of dollars of government liabilities and leaves the government holding some asset that could carry default risk. Note that the Fed does keep a separate balance sheet and normally runs a profit. Its assets earn more than it pays on its liabilities. Profits on Fed equity above 6% are turned over to the Treasury. If, as a result of all of its bailout activities, the Fed's profitability is diminished, Treasury's revenues will suffer. If the Fed were to accumulate massive losses, the Treasury would have to bail it out, with Congress budgeting for the losses. We are not projecting that this will be the case. We are merely pointing out that, in practice, the Fed's promises are ultimately Uncle Sam's promises, and these promises are made without congressional approval, or even its knowledge many months after the fact. We also are not implying that Uncle Sam would not be able to keep these promises. There is no default risk on federal government debt, and our government can afford to meet any and all commitments it makes. We are simply emphasizing that a Fed promise is ultimately a Treasury promise that carries the full faith and credit of the U.S. government. We are not concerned with government solvency, but are only addressing the democratic accountability question. Should the Fed be able to make these commitments behind closed doors without the consent of Congress? Some will object that there is a fundamental difference between spending by the Fed and spending by the Treasury. the Fed's actions are limited to purchasing financial assets, lending against collateral, and guaranteeing private liabilities, while the Treasury also operates some lending programs and guarantees private liabilities, for example, through the FDIC and Sallie Mae programs. And while it has purchased private equities in recent bailouts, of GM, for example, most of its spending takes the form of transfer payments and purchases of real output. Yet, when the Treasury engages in lending or guarantees, its funds must be approved by Congress. The Fed does not face such a budgetary constraint. It can commit Uncle Sam to trillions of dollars of commitments without going to Congress. Further, when the Treasury provides a transfer payment to a Social Security recipient, a credit to the recipient's bank account will be created, and the bank's reserves are credited by the same amount. If the Fed were to buy a private financial asset from the same retiree, let us say it is a security, the bank account would be credited in exactly the same manner, and the bank's reserves would also be credited. In the first case, Congress has approved the payment to the Social Security beneficiary. In the second case, no congressional approval was obtained. While these two operations are likely to lead to very different outcomes, the Social Security recipient's income has risen and he/she is likely to spend the receipt. The sale of a security simply increases the seller's liquidity rather than his/her income and may not induce spending by the seller. So far as committing Uncle Sam, they are equivalent because each leads to the creation of a bank deposit as well as bank reserves that are government liability. There is a difference in the impact on the federal government's reported budget. However, spending by the Treasury that is not offset by tax revenue will lead to a reported budget deficit, and normally to an increase in the outstanding government debt stock. By contrast, purchases or loans by the Fed lead to an increase of outstanding bank reserves, an IOU of the Fed, that is not counted as part of deficit spending or as government debt, assuming there is ultimately no default on assets purchased by the Fed. The details of all this are complicated, and there can be knock-on effects that complicate matters further. While this could be seen as an advantage because it effectively keeps a bailout off the books, it comes at the cost of reduced accountability and less democratic deliberation. This is unfortunate because operationally there is no difference between a bailout that is taken on the books by the Treasury, thus following normal budgeting procedure, and one that is off the books undertaken by the Fed, thus largely unaccountable. Bailouts necessarily result in winners and losers, and socialization of losses. At the end of the 1980s, when it became necessary to resolve the thrift industry, Congress created an authority, the Resolution Trust Corporation, and budgeted funds for the resolution. It was recognized that losses would be socialized, with a final accounting in the neighborhood of $200 billion. Government officials involved in the resolution were held accountable for their actions, and more than 1,000 top management officers of thrifts went to prison. While undoubtedly imperfect, the resolution was properly funded, implemented, and managed to completion. By contrast, the bailouts so far in this much more serious crisis have been uncoordinated, mostly off-budget, and done largely in secret, and mostly by the Fed. There were exceptions, of course. There was a spirited public debate about whether government ought to rescue the auto industry. In the end, funds were budgeted, government took an equity share and an active role in decision-making, and openly picked winners and losers. Again, the rescue was imperfect, but today it seems to have been successful. Whether it will still look successful a decade from now, we cannot know. But at least we do know that Congress decided the industry was worth saving as a matter of public policy. No such public debate occurred in the case of, say, Goldman Sachs, which was apparently saved by a series of indirect measures. For example, providing funds to AIG that were immediately and secretly passed through to Goldman. There was never any public discussion of the need to rescue Goldman through the backdoor means of providing funds to AIG. Indeed, those actions were only discovered after the fact. The main public justification for rescuing financial institutions has been the supposed need to get credit flowing again. But if so, the bailouts have been largely unsuccessful. And given debt loads in the private sector, encouraging lending is probably unwise in any case. Alternative methods of stimulating credit, or better, of stimulating private spending, have hardly been discussed. Indeed, the massive sums already provided to Wall Street, again, mostly off budget, prove to be a tremendous barrier to formulating another stimulus package for Main Street. Even as labor markets remain moribund, as homeowners continue to face foreclosures, and as retailers face bankruptcy, Congress fears voter backlash about additional government commitments. While economists make a fine distinction between commitments made by the Fed versus those by the Treasury, voters do not. Uncle Sam is on the hook, no matter who put him there. Voters want to know what good has been accomplished by expanding the Fed's balance sheet liabilities to $2 trillion, and by extension of Uncle Sam's commitments by perhaps $20 trillion through loans, guarantees, and bailouts. We hope this paper will encourage policymakers to explore the following issues surrounding transparency and accountability. Number 1. Is there an operational difference between commitments made by the Fed and those made by the Treasury? What are the linkages between the Fed's balance sheet and the Treasury's? Number 2. Are there conflicts arising between the Fed's responsibility for normal monetary policy operations and the need to operate a government safety net to deal with severe systemic crises? Number 3. How much transparency and accountability should the Fed's operations be exposed to? Are different levels of transparency and accountability appropriate for different kinds of operations? Formulation of interest rate policy, oversight and regulation, resolving individual institutions, and rescuing an entire industry during a financial crisis. Number 4. Should safety net operations during a crisis be subject to normal congressional oversight and budgeting? Should such operations be on or off budget? Should extensions of government guarantees, whether by Fed or by Treasury, be subject to congressional approval? Number 5. Is there any practical difference between Fed liabilities, banknotes and reserves, and Treasury liabilities, coins and bonds or bills? If the Fed spends by keystrokes, crediting balance sheets, as Chairman Bernanke says, can or does the Treasury spend in the same manner? Number 6. Is there a limit to the Fed's ability to spend, lend, or guarantee? Is there a limit to the Treasury's ability to spend, lend, or guarantee? If so, what are those limits? And what are the consequences of increasing Fed and Treasury liabilities? Number 7. What can we learn from the successful resolution of the 1980s thrift crisis that could be applicable to the current crisis? Going forward, is there a better way to handle resolutions of financial crises, putting in place a template for a government safety net to deal with systemic crises when they occur? Note that this is a separate question from creation of a systemic regulator to attempt to prevent crises from occurring. However, Congress should explore the wisdom of separating the safety net's operation from the operations of a systemic regulator. Number 8. What should be the main focuses of the government safety net? Possibilities include rescuing and preserving insolvent financial institutions versus resolving them, encouraging private lending versus direct spending by government to create aggregate demand and jobs, Debt relief versus protection of interests of financial institutions. Minimizing budgetary costs to government versus minimizing private or social costs.